In this session, I will introduce you to one of the most important ratios: price to book value. Price to book value or PB ratio is widely used for valuing a company stock. Before I explain price to book value, let's recall the term book value from balance sheet session. Company's total assets minus total liabilities gives you shareholders' equity. This is also called as book value of the company. Book value divided by number of shares outstanding will give you book value per share. In short, this is the amount of money left on the table after company pays off its debt obligations. In case company enters bankruptcy or need to close its operation, this is the amount of money investors can expect to get back. Price to book value ratio is calculated as company's share price divided by book value per share. You will get share price from the stock market. Book value per share is calculated as book value divided by number of shares issued by the company. PB ratio can be used to compare the performance of two companies. Let's understand with example. Suppose there are two companies. For simplicity, let's assume both the companies are in similar business model and making similar product. Company A, trading for 40, while Company B is trading for 20. The new investor might assume that Company B stock might be the best because it is cheaper compared to Company A. But this is not necessarily true. Low share price does not mean stock is undervalued. Let's get into the details and make few more assumptions. Company A has book value of 100,000. If there are 5,000 shares issued, you will get book value per share of 20. Let's assume Company B has book value of 50,000. If there are 10,000 shares issued, you will get book value per share of 5. Now, it's time to calculate PB ratio for both the companies, which is stock price divided by book value per share. Company A is currently trading at 40, having book value per share of 20. This will give you PB ratio of 2. This means company is trading at 2 times its book value. In the event that company is liquidated, stock investors are expected to receive half of their investment back when all the assets are sold off. This is because company is currently trading at 2 times its net assets or book value. Company generally trades at higher multiples of book value when investors believe that company can use its assets and grow in future to bring more value. On the similar line, Company B is currently trading at 20 having book value of 5. This will give you PB ratio of 4. This means Company B stock is trading at 4 times its book value. In the event that company is liquidated, equity investors are expected to receive 1/4 of their investment back when all the assets are sold off. In this case, based on PB ratio, Company A seems to be better value, whereas Company B looks expensive. Until now, it seems that high PB ratio could mean that a company's stock is overvalued. On the other side, low PB ratio could mean that a company's stock is undervalued. Please remember, low PB does not necessarily mean stock is undervalued. Let's try to understand when and how to use PB ratio. PB ratio looks at net assets of the company. However, not all companies are created equal. Let's think about commodity business like oil and gas, metals and so on. Their earnings power comes mainly from the tangible assets. This includes company property, plant, equipment, machinery and so on. These companies need to invest into tangible assets for future growth. In short, such companies are dependent on their assets to generate the income. PB ratio works well for such companies that are asset intensive. On the other side, let's consider business like software services or product. Their earnings power comes mainly from the intangible assets like software code, patents, employee talent and so on. PB ratio does not work well for businesses that are asset light. P/B ratio is one of the important ratios while valuing a stock. This will be covered in more details during valuation. Thank you.